Okay, that was incredible because I think we basically just came up with 6 or 7 very good reasons why banks should not use AI.
It actually turns out that like if you get the governance and the validation right, these things are incredibly powerful. It's like nuclear energy. It can power large municipalities and cleanly. But if you don't get the governance right, it'll kill you in the process.
So, and I love to hear it. It really all comes down to good oversight again.
Exactly.
um,
And I think that that's frankly why you've had a lot of analysts on Wall Street asking, when are we going to see all of the huge margin improvements from these massive AI investments that public companies have been making? And so far, they have not materialized.
Hello and welcome to In Control, where we learn about the finance of everything. I'm Tash, your host. If you enjoy this podcast, please subscribe on Apple Podcasts or Spotify and share it with your friends and colleagues. Now, I spend most of my working life trying to understand bank data and helping banks deploy software and AI to help them be more efficient and compliant with regulations. And one thing that I know is understanding bank data and deploying AI in banks is hard. My experience is that banks are all over the spectrum when it comes to AI maturity. Some are still fighting to get Copilot approved for use internally. Others are writing requests for proposals with ChatGPT and asking for things they don't even understand. And some are successfully deploying agents and seeing huge ROI gains. Unlike most companies, though, banks also have the joy of having to appease their regulators. And that includes the magical world of model validation. Model validation is a model risk management process required by regulators to ensure models are accurate, robust, and operating as intended. All that to say, successfully deploying AI and agents inside a bank is no small feat. So today, I'm speaking to Kareem Saleh, CEO and founder of Fairplay, to understand how banks can use AI successfully. Fairplay is a platform that tests, optimizes, and validates machine learning models, AI, and agents for financial institutions. And so he's the perfect person to teach me all about this. Kareem, thank you for joining me today. I want to start off by talking a little bit about the old world, which really is only 2 or 3 years ago now, and to get into how banks and financial institutions have been using machine learning for years.
Well, thanks for having me, Tash. Delighted to be here. As you point out, banks have been using machine learning for quite some time, primarily in areas like marketing and fraud detection and underwriting. And those machine learning systems at their core are essentially very sophisticated calculators. They take in structured data and they output usually like a probability or a score or a classification. So, for example, like what's the probability this person defaults? What's the probability this transaction is fraudulent? Will this customer respond to this offer? And an important feature of those machine learning models is that they are deterministic. And that basically means like if you ask the robot the same question 10 times, the robot gives you the same answer 10 times. Uh, Machine learning models increasingly can also be made explainable, which means that you can like decompose the drivers of a decision and like trace the outputs back to the inputs. Now, model validation of machine learning models is not trivial, but it is manageable and it is relatively well understood by banks. You can validate the model, you benchmark the model, you monitor it over time. And so banks have been using machine learning, which is a form of AI, for a long time. And while complex, there is a model validation regime that is well theorized and actionable.
hmm And so, in this old world, machine learning that's more deterministic, being used for fraud detection, marketing, and so on, what were the risks or challenges that banks had in using them? Like, what were they worried about? What were they thinking about as they went to deploy some of these machine learning models?
Yeah, typically it was like if I vary the inputs a little bit, do the outputs of the model vary wildly? Is the model conceptually sound? Like, is the modeling technique appropriate for the application? How does the model perform under stress conditions? Let's say if the world changes and the knock-on door population changes, or something in the macro environment changes. But for the most part, the models were narrowly scoped to a problem, and they had very few degrees of freedom in terms of the kinds of decisions they could make. Now, of course, we live in a new world with new AI techniques and developments, and a lot of that traditional method of validation is challenged by the emergence of these new AI methodologies.
Yeah. And so those traditional machine learning models, is it correct that they were, let's say, like a bit more stable in that a bank might deploy one and not change it, and that same model might sort of be in its current form for a long period of time? Or were they always training it and changing it and updating it?
Well, for sure they were. Updating the models and retraining the models, but the models were relatively well supervised, and they were not terribly dynamic. And what changes in a world of generative AI and agents is that those systems are much more complex and much more dynamic, and they have, in many cases, uh, greater degrees of autonomy. Another key sort of difference, and I'm sure we'll dive into this, is that, for the most part, the traditional models all output a score. And where you have a score, like a numerical value, and you have ground truth, you can make judgments about whether those models are accurate. But in the new world, as we'll discuss, oftentimes what's being output by the models are ideas, right? It might be a strategy, it might be a recommendation, it might make a judgment. And in many cases, it's much harder to know what's a good idea, what's a bad idea, what's an incorrect judgment.
Yeah. And in the old world, if these models are outputting a score, presumably then it's down to the bank and their own risk appetite and their own policies and procedures to say, if a model produces this score, we do this next step with that score and with that information. And that's also probably a fundamental difference between the old world and where we are now.
Correct.
Okay, interesting. So before we jump into the new world, the final thing I want to really wrap my head around, like with traditional machine learning models, is how did the regulators get comfortable with banks using this? Talk to me a little bit more about model validation. What did that actually mean? How do regulators get comfortable? What do banks have to do to get them comfy?
Yeah, well, we had, I think, a number of developments that ultimately got the regulators comfortable with using machine learning in high stakes applications in financial services like credit underwriting. And those have been things like a lot of public studies, for example, from places like FinReg Lab, that have done essentially public-private partnerships around things like the use of machine learning, the use of cash flow data, where they'll bring together a cross-section of industry participants, banks, regulators, fintechs, data providers, and they'll essentially run kind of public experiments about the models, what their failure modes are, what the best practices for validation are, for training, testing, and tuning the models, et cetera. And so, but that all took time. I mean, some of the earliest machine learning models in credit underwriting were brought to market, in 2013, 2014, 2015 by companies like Affirm and Upstart. And it wasn't really until 2019 that we get the FinReg Lab paper on machine learning explainability in credit underwriting, and the joint statement by the federal financial regulators in the US around approving the use of cash flow underwriting. Oftentimes what we see is, these fintech pioneers charting a new course, industry kind of taking notice, regulators taking notice, and then we basically have to have a kind of intra-industry coalition, standard-setting coalition to decide kind of what good validation looks like of machine learning models.
Okay, interesting. And so really banks had kind of more recently just got their hands around model validation. It's a fairly new thing for them to do, and then the world changed again.
Yeah.
All right. So let's jump into that new world then. AI, agents, generative AI. There's a ton of new challenges that this brings to banks. You've got the data challenge, you've got deployment, you've got the understanding, you've got getting everyone comfortable. Why don't you just explain to me to begin with sort of how you see the new challenges for banks coming about, and then we'll maybe walk through them
Yeah,
individually.
for sure. So, first of all, I think it's important to note that there are two things at work here. You have generative AI and agentic AI, and they're related, but let's separate them. So, generative AI creates content, agentic AI executes tasks. Now, generative AI poses a unique set of challenges: non-determinism, hallucination, the black box problem. We can dive into each of those. And then you have agents. Agents can perceive the world around them, they can act on the world around them, and they learn from the world around them. And the agents are often a combination of large language models, machine learning models, rule based systems, and they can act autonomously to do things like call tools or interact with external systems or trigger certain workflows. And the challenge with both generative and agentic systems is now, as we were talking about a moment ago, you're dealing with systems that are much more dynamic, much more complex, and much more opaque than the traditional machine learning models that banks have only recently become accustomed to using.
Mm-hmm.
Now, let's dive a little bit deeper into those risks of generative AI that we were talking about. So we've spent some time talking about non-determinism, which basically means, again, like, you give the model or the robot the same inputs, and some percentage of the time you get different outputs. That's obviously a problem if you're a financial institution, right? Like if you claim to approve everybody above a credit score of 700, then every 700 should be approved. It can't be that 20% of the time you're denying folks who meet the eligibility criteria, right? So non-determinism poses a unique challenge to banks and financial institutions. The second challenge you have is hallucination, which is like sometimes these models are just eager to please and they give you confident but incorrect responses. And you see this somewhat hilariously these days in the practice of law, where all these lawyers are getting in trouble for filing briefs with courts that cite cases that never existed.
Mm-hmm.
And then, of course, generative AI is uniquely challenging from explainability perspective. These deep neural networks are so computationally complex that it is virtually impossible to understand why a conclusion was reached or why a decision was made. Now, on top of all of that, if you add agents into the mix, the risks expand significantly, right? Because now you've got the risk of runaway behavior, right? Agents taking actions beyond their intended scope. You've got the risk of misaligned objectives, like optimizing for the wrong goal. Like imagine you're like an insurance company and you give your insurance agent the guidance that you want to make sure to disposition customer claims quickly. Well, you might disposition customer claims quickly by just like denying them all from the start, right? So it's very possible for these agents to misinterpret their instructions, resulting in misaligned objectives. You've also got the problem of data leakage, right? Like leaking sensitive or regulated information. That's been known to happen with these agentic systems, especially if there aren't clear limits on like what actions they can take and what they can't take. And then we're also starting to see kind of like adversarial attacks on these agents, right? The manipulation of the agent via malicious prompts or inputs. Uh, and all of that is just talking about one agent. Now imagine you had multi-agent systems or swarms of agents. Well, the risks there are also compounded, right? Because at a very simple level, you can have coordination failures between these agents, right? The agents like working at cross purposes or perhaps taking duplicative or conflicting actions. You can also get, the problem of cascading errors, right? So you have a small mistake made by one agent, propagates and compounds in downstream systems. And I think there's one more critical point is that almost all of these systems are built on top of foundation models that the agent developers and users don't control, right? And so the core challenge that banks face with generative and agentic AI is like, how do you maintain control of a system that is inherently non-deterministic and largely outside your visibility?
Okay, that was incredible because I think we basically just came up with 6 or 7 very good reasons why banks should not use AI, and then we're going to come on and talk about how to mitigate these risks. But literally, they might just make up answers every now and again, non-determinism, or they might give you different answers for the same question. Secondly, they might just tell you the wrong thing, hallucination. Thirdly, runaway behaviors. They might just go off and do something that you haven't asked them to do. Fourthly, they might have misaligned objectives. If you're not absolutely clear with your prompts, they might go optimize for one thing when you actually would have preferred them to optimize for the other. Fifth, there's a possibility of data leakages. Sixth, there's the possibility of attacks. And then if you have multiple agents, you've got coordination failures and cascading errors. That all sounds like a bunch of reasons why no one should use generative AI and agents, particularly in financial services. So let's tell me why anyone would want to use them then. Like, what on earth? Those sound like really, really good reasons to never touch this.
Yeah, well, it turns out that appropriately validated and well governed, that these agents can actually do as good of a job, if not a better job, than many humans that are performing these tasks inside banks today. And so especially in areas where there is a lot of people, where the processes are heavily dependent on manual interventions by humans, and where you have like a lot of wasted time in the form of running down things like false positives for BSA, AML, KYC type applications. So actually, like these tools, notwithstanding the parade of horrible risks I outlined for you, it actually turns out that like if you get the governance and the validation right, these things are incredibly powerful. It's like nuclear energy. It can power large municipalities and cleanly. But if you don't get the governance right, it'll kill you in the process.
Yeah, that's probably a pretty good analogy there. I definitely want to get into how you handle the governance to make this stuff really usable. But before we get there, given we're talking about, financial services and banking, with some of these risks that you've outlined for us, what are the potential consumer harm or the impacts that could come about if this is not done properly, if you don't have all of the governance in place that we're about to talk about?
Well, I mean, let's just go application by application. So think about the onboarding process. If your agent runs amok in the onboarding process, you can both deny, consumers who ought to be approved. You might also miss some money laundering that you ought to have caught. Let's take a look at collections. You may have agentic collectors that either become abusive or that systematically offer workouts to men but not women. So bias in the treatment of customers. In underwriting, you may have a tendency for the agent to overfit to populations that are well represented in the data, leading to the exclusion of folks whose data is more likely to be messy, missing, or wrong, which we know for 50 to 60 million Americans is the case. And then, of course, there are all of the risks that these agentic systems pose to the safety and soundness of the financial institutions themselves. I mean, imagine getting, the ledgering incorrect and not knowing who owns what on your ledger, or imagine, getting your risk capital ratios wrong. Now all of a sudden the solvency of the bank is in question. So the potential harms both to consumers and to the institutions who use these agentic systems they can be grave.
So talk to me about how can you get clear on this non-deterministic nature? How can you handle hallucinations? How do you stop runaway behavior with agents? explain how this is actually possible.
Yeah. So I think the first thing to note is that the core principles of model validation, things like conceptual soundness, like is the system appropriate for its application, outcomes analysis, like is the system behaving appropriately, are the outcomes reasonable, and ongoing monitoring, will we know if the system starts to drift? All of these principles, conceptual soundness, outcomes analysis, ongoing monitoring, they all still apply in the world of generative AI and agents. It's just that the validation tactics themselves need to evolve. I'd say it's also time to kind of move from static point in time model validation to continuous system validation. So we tend to kind of very narrowly define models in the past. And now with these generative and agentic systems, we need to be taking much more of a systems level approach, not necessarily a model level approach. Now, broadly, there are probably two categories of AI risks banks need to manage. The first are some of the general AI risks that we have been talking about that apply to most generative models and agents, like hallucination, prompt injection, non-determinism, lack of explainability. For all of those, you need guardrails and systematic testing, right? So stress testing of the prompts, adversarial testing of the models, trying to induce the model or the agent to perdition, monitoring the consistency of the outputs, and then evaluating behavior across different scenarios and edge cases.
And are those things that you talk about, are they done over a period of time by a company like Fairplay that can help with this before the AI is deployed into production? Or is this something that actually really needs to be ongoing, a system that sort of sits underneath or on top of your AI and is constantly evaluating and giving you that feedback?
Yeah, both. So you need to do pre-launch validation to get a kind of baseline level of performance, and then you have to do ongoing continuous testing to monitor for drift or degradation in the system or the agent, because the prompts drift, the models change, and new threat vectors and new failure modes emerge.
Hmm. And does this then, so if you have a model and you're using it, let's talk about like an agentic AI system, and you're using it in the financial crime space, um, and you have another model that you're using in the lending space, another agentic system you're using in the lending space, and another one in the onboarding flow. Do you then need a sort of validation system that sits under each of those that is tuned to each of those?
Well, what you need are kind of the second category of risks that need to be managed beyond the general risks that we've been talking about are these domain specific risks that you have been discussing, right? So like, for example, in the BSA, AML, KYC space, not only is it enough, it's not enough to ask just, do I have a hallucination guardrail? You have to actually ask like, can this agent actually identify financial crime, right? Can this agent detect a politically exposed person? Can this agent perform sanction screening accurately? So not only do you have to worry about whether or not you're managing all the kind of general AI risks, you have to worry about whether or not the agent or the system works reliably in your specific regulatory context. Yeah.
And that's really interesting because it sounds like the basically like the implementation of any of these systems suddenly becomes much more personalized, and that sounds to me like it really goes to margin of these companies, because like one of the beauties of software as a service or SaaS over the last 20 plus years has been, once you build this system, you can deploy it to everybody, and your margin, the amount of money that you keep after that implementation, after that deployment, is actually really high because everybody's using the same piece of software. But what you're talking about to me sounds like everybody's implementation needs to be a little bit different. This concept of maybe forward deployed engineers, this concept of maybe a more intense onboarding process, which really will then just hit the margins of these companies. Is that right?
Well, yes and no. I mean, even these SaaS companies have some level of kind of continuous integration and continuous deployment, continuous quality assurance, right? Especially as, updates get pushed and new code gets pushed and so forth. So now I think you're right that like the rigor and the frequency of the evaluations of these systems will for sure be higher. But I think also, the cost of computation is essentially free. Computation is essentially free and infinite, and the cost of generating synthetic tests is going down by the day. So it's not actually clear to me how the margin profile of these companies will actually be affected in the end.
Okay, interesting. So let's dig in on a specific example. Let's talk about generative AI and those hallucinations. Like, literally, how do you guard against that then? If you're a bank and your board is particularly concerned about hallucinations, what do you do?
Yeah, so the first thing you do is you have to put in place what are kind of called hallucination guardrails, which is essentially a prompt that sits on top of your prompt, or sometimes it can be another model that's checking the outputs of your primary model. But basically, what you want is some kind of mixture of experts to constantly be fact checking, to constantly be asking, like, are the outputs of this system reasonable? And then on the back end, you should probably still have, humans who are doing 10% samples to make sure that the outputs from the agent aren't, hallucinations. So I think you need both guardrails kind of at the front end, and that can be a system of other models which check or gauge or assess the quality of the outputs from the incumbent model. And you can have human-led audits on the back end to make sure that nothing is getting past the guardrails.
Is that just, is it then that you're basically like rerunning the prompt, the thing that the generative AI is supposed to be doing to see if you've got matching answers? Is that pretty much what
Yeah,
happens?
it's like giving the same task to another model and
Hmm.
and then evaluating the differences in the outputs between the two.
And do you need to make sure in that situation that you're using a different base LLM so that you're sort of mixing up the risk of a double hallucination error?
That's the best practice, yeah, for sure.
Interesting. Okay.
Of course, that also now drives your token costs, doubles your
Yeah.
token costs.
Yeah, and that all those efficiencies that you're gaining from using AI, you got to spend on more technology. So
Right.
interesting. And so let's then take an agentic AI example. You talked about like runaway behaviors, the risk that agents might just go off and do something that you have not asked them to do. How do you guard against that?
Yeah. By trying to very narrowly scope the authority of the agent to take action and to have very clear boundaries between where one agent's work trails off and another agent's work begins. So I think where people are seeing the greatest success with containing kind of agents is by giving them very, very narrow tasks.
Give us an example of how this might work.
Yeah, so for example, in a BSA, KYC, AML flow, you might have an agent that is, running names through a database. Then the outputs of those names might be given to an agent who does nothing but sort that list of names. And then a third agent might, run those names against a narrowly defined database, basically chunking up the work into small enough pieces that the autonomy of the agent to create problems is severely limited.
Those sound, I mean, this might just be my lack of understanding, is probably that. And it might be the example that we're using, but those sound like basically just like individual scripts being written and run across certain sets of data, and then an API moving the result from one script to another. What am I getting wrong in how I'm thinking about that makes it more complicated?
Well, I don't think you're wrong about that. I think first of all, I think a lot of what gets pitched as agentic AI are, in fact, Rube Goldberg machines of machine learning models and rules-based systems, and maybe with a little LLM sprinkled in for good measure. But I think also, there is this coordination problem that you have across all of those different scripts. And that, in a sense, is sort of new and truly agentic, especially if the agent has the system has autonomy to achieve these objectives through not very clearly defined pathways. And so, I think what you're seeing here is really the evolution from this world of narrowly defined scripts into a kind of orchestration layer of many, many different routines, some of which may be dynamically routed or otherwise completed in non-traditional ways that make these systems much more dynamic, much more complex, much more autonomous than the ones that came before them.
Okay, interesting. Okay, let's take one more example. So the misaligned objectives risk with agentic AI, where you are wanting the agent to optimize for fairness across all of your lending, but you also need it to close out cases quickly, and it ends up sort of prioritizing one or the other of those. How do you mitigate against that risk?
Yeah, well, so there you can do very clear testing about whether some populations are making it through your process at higher or lower rates. Like, at what rate are women passing your KYC screen relative to men? At what rate are elderly people, being approved for loans relative to the middle-aged? You can do all kinds of population level analyses to understand if there's some systematic bias by geography, by race, by age, by gender, arising from the use of your agentic system.
Interesting. Okay. And then let's talk about how banks can actually start using this and evidence to the regulators that they're doing so in a way that they truly understand what's going on here. I'm a bank. I've been given this board directive to get some AI for something. How do I go about doing that in the right way?
Yeah, so I think, as with all models, the regulators are going to look to see if the banks can demonstrate that they understand the systems they're using, have reasonable controls to govern their use, and can generate some evidence of ongoing monitoring, testing, and remediation. So I think the institutions that succeed in this new world will be the ones who not only sort of move fast with AI, but also are able to demonstrate that they have a reasonable understanding of how it behaves, that they've taken reasonable measures to control its risks, and that they have adequate evidence to prove that they've done all of that to their regulators and stakeholders.
Yeah. Interesting. So there's a couple of things that come to mind there. The first is, are regulators generally okay with the concept of the risk appetite being applied here? So for those listening who are less aware of this concept, if you are a bank, for example, and you are deciding how to handle financial crimes risk, money laundering and fraud, you can define your own risk appetite about the amount of crime that you're willing to sort of accept in your financial institution. And then, as long as your policies and procedures map to that risk appetite, then you're kind of okay. Your job is to kind of prove to the regulators that you're doing what you've defined in your policies and procedures, and that those do truly map to your risk appetite. Is there a level of risk acceptance here that, okay, we actually don't need 100% accuracy, and some hallucinations are okay if it's defined in your risk appetite, and we are okay if there is some misaligned objectives because it's defined in our risk appetite? Is that acceptable with this?
Well, I think certainly the humans who are doing this work today are not perfect.
Mm-hmm.
And so expecting that the robots that do this work to be perfect seems like an unreasonable benchmark. So I think the question is can you be reasonably assured that the machines are doing as good of a job, if not a better job, that the humans that were doing this work previously? And there it gets to, what was your oversight of those humans? How much How much substandard performance did you expect from them before performance managing them either to improve or out of the organization? So I think of all of these AI systems and AI agents as just kind of like digital employees, synthetic employees, if you will. And this you apply the same controls and risk tolerances that you would for the humans that are doing that work today.
Interesting. So, and I love to hear it. It really all comes down to good oversight again.
Exactly.
My final question for you, Kareem, is how how confident are we that the regulators really understand this and are thinking about their oversight of the banks in the right way?
Well, I think we do have an administration, at least at the OCC, but I think really across the organization, across the administration, that is very seized with making sure that America wins the kind of AI race. They're certainly very encouraging of AI use. The president has put out an executive order directing all of the agencies to evaluate how their operations can be made more efficient through the use of AI. And so I think actually there is a lot of receptivity on the part of the federal financial regulators now to deploy AI across the financial system. Now, that pendulum could swing back, and you could have a new head of the OCC who took a dimmer view in the future. And that's why I think, as we've been talking about, being able to, demonstrate that you have adequate controls to govern the use of your AI and being able to generate evidence that you're testing, monitoring, remediating mistakes when you find them. I think all of that is going to be essential, kind of regardless of which administration is in place.
Yeah, yeah, that makes sense. Um, okay, what am I not asking you? What am I not thinking about when it comes to AI and being, having it deployed in banks?
I think you've been very thorough. I mean, one of the things that keeps me up at night are some of these um, multi-agent some of the risks that arise from these multi-agent systems. I mean, one of the things that I don't think we discussed is something like, emergent misbehavior, including things like algorithmic collusion, right? So you can have a situation where the AIs want to achieve an objective that might be impermissible, but are able, like, dividing up the tasks among one another so that no agent's particular single behavior is outside of policy, but the ultimate outcome is something that would have been verboten. And so one of the things that I worry a little bit about is, these complex multi-agent systems and the potential for algorithmic collusion, emergent misbehavior, or even just kind of like feedback failures where, you have agents that are reinforcing one another's errors or amplifying bad decisions over time.
How do banks mitigate that risk?
I think that like we're headed for a world where where every bank is going to have a control plane for all of these agentic systems, and we're going to have just like we do in aviation, a series of fail safes and safeguards and alert systems that start to get our attention if these systems degrade in production or start to have outcomes that pose a threat either to the safety and soundness of the institution that's using them or to the consumers they serve.
Could these banks end up having to run sort of like a secondary non-AI system that is there as a failsafe? If the AI stops working, they can flip the switch and have everyone run on their old traditional system.
That is a best practice.
Wow. And so then it comes down to like, what are the actual efficiency gains that you're getting here when you're having to run two technology systems versus just the one?
Uh, Correct. And I think that that's frankly why you've had a lot of analysts on Wall Street asking, when are we going to see all of the huge margin improvements from these massive AI investments that public companies have been making? And so far, they have not materialized.
That's interesting. And it also this SaaS apocalypse that we're in, where the valuation of all these public SaaS companies, the more traditional software as a service companies, has really plummeted in the recent weeks and months. Maybe we'll see a stabilization of some of those for companies that serve financial institutions.
Only time will tell.
Yeah. Wow, Kareem, this has been fascinating. Thank you so much for teaching me about how banks can safely and securely and in an evidenceable way deploy AI. I have really enjoyed our conversation.
Thanks for having me, Tash. I've enjoyed it too.
And if you enjoyed this, please share it with your friends and colleagues and subscribe on Apple Podcasts or Spotify. And I'll see you next week for another episode of In Control.